About 30% of the companies in the S&P 500 index have reported third quarter results. Citi says the earnings are shaping up better than expected. Let's get more from Scott Chronert, U.S. equity strategist at Citi. Scott, thanks very much indeed for joining us. Just give us an overall view here. Have beats exceeded misses, for example?
Yeah, good morning, Andrew. So yes, I'd see so far into the quarterly reporting period, what we're seeing is a positive surprise dynamic that's a little bit stronger than we would have expected. Why? The typical setup is that you tend to see revisions lower into a quarterly reporting period such that you then get a more normal or upside surprise to the numbers. This time, however, we did not see that same magnitude of negative earnings. In fact, revisions had remained quite solid. So our expectation was that we would see a positive surprise in a more normal fashion in the 3 to 4% range. But through the last couple of days, we've seen a Q3 positive surprise that's closer to 7 to 8%. So it just goes to show just how strong current S&P 500 fundamentals are at this point. Now, we have a big week coming up with 5 of the Mag 7 reporting. This is where I think we're going to get the bigger test in terms of this notion of how the earnings are looking themselves versus what's already been priced into stocks. So again, look for a test over the next couple of days. But in general, I'd say, Andrew, the earnings period is shaping up quite smartly here.
Speaking to big investors, you reckon a lot of them are reluctant bulls. They're steadfast in holding big cap stocks, but they're worried about the risk of an AI bubble, for example.
Yeah, that's sort of the really intriguing storyline here is that it seems like every conversation these days is valuation bubble, valuation bubble. Those concerns, because of what we experienced back in the tech bubble era in the late 90s, early 2000s, and then, with the credit situation that has been sneakily creeping into conversations recently, the way we're looking at it is that even though positioning has been quite bullish U.S. equities, when you talk to investors about their and get a sense of where sentiment really is, it's actually fairly nervous given the move we've had, the heightened valuations. And so we're using this phrase reluctant bulls to describe the circumstance right now. And what that basically tells us is that we should expect that as we get ongoing positive surprises and upticks to forward expectations, we suspect stocks will react positively to that. And then on the flip side, and this is sort of intuitive, if you will, where you see disappointments, then those reluctant bulls will have a very good reason to sell. So what we're expecting as a result is a heightened period of volatility as we go through this reporting period along the lines of what I just mentioned.
In terms of sectors that you like, you are overweight financials and infotech.
Right. So you mentioned the strength in copper recently, and what I would say is that generally speaking, what we're looking at in terms of a setup for Q4 is an ongoing focus on what we'd say the growth parts of the market, and that's where that tech longstanding overweight for us comes into play. Semiconductors, software, all fit the mode on this. We're also suggesting for Q4 an increased weighting in the cyclical parts of U.S. equities. So we lead with a financials call, which is essentially large cap banks here in the U.S. But then we also think that there are other more cyclical areas that would include the retail section of the market, the durables component, which is where you pick up some of the home builders and related housing stocks. And then we've also begun to get incrementally more constructive on the capital goods part. So what we're doing here very simply is allowing that the S&P 500 right now is beating to 2 different drums. One is the AI tailwind, which is where this tech growth component comes in. The other is the broader economy. And as we go further down this Fed rate cut path, begin to lap as we go into 2026, a lot of the policy consternation that's been at work this year. We think the market sets up for an ongoing broadening dynamic, and that's where we want to kind of incrementally be increasing our cyclical exposure to U.S. equities.
A couple of areas that you're cooler on, consumer staples, but also industrials. Start off with industrials. Why are you relatively
Yeah.
wary there?
Yeah, so industrials has been an underweight for us all year, and let's just acknowledge that we've been wrong on that particular call. What's happened here is that areas of the industrials that are going to be more attached to the opportunities in aerospace and defense, for example, and as well as some of the plays that have kind of caught in some interest in terms of the tag-along effects of the AI build-out, have led that part of the market. But what it's led to is sort of an outsized valuation issue for us, where those stocks look increasingly expensive versus their history. So while we acknowledge the move, we're finding that more is being priced in that particular area of the cyclical setup, which is why I come back and say there are other areas that we think from a cyclical economic sensitive perspective stand out a little bit more. That's where we look at consumer discretionary. As pertains to the staples parts of the market, we think we're a little bit more in the crosshairs of where ongoing tariff work is going to lead in terms of the risk of margin pressure. As you see, the issue that with tariffs is that one where you're not able to price through the tariff cost to the degree you think because of a fairly stretched aggregate consumer. And so what our concern with the staples part is that they don't have the historic pricing power that you need for many of those household goods companies to actually do quite well in this. So we kind of segment that part out as an underweight relative to the more traditional retail part of the consumer, where there we think there's a bit more leverage as you see rates coming down.
Scott, thank you very much indeed.
You bet. Have a good day, Andrew.
You too. Scott Chronert, U.S. equity strategist at Citi.